Here's what's coming up on the Peak Financial Freedom Show with Jim and Dan.
There's a 39% loss every 5 years in the market historically. So if you're 60 and you're going to live to 90, that means you're going to have 6 more 39% losses that you have to somehow navigate through.
We got her excess cash flow of $2,493 above her budget of $7,000. And that's significant because that adds up to $29,916 every year in what we call excess cash flow.
We can show her how much tax she's going to pay, and we can show her each month how much net after-tax income she's going to have in her hand to spend. She will worry a lot less about her money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome to this week's show.
We have 30 minutes of great information designed just for you.
Don't go anywhere. Make yourselves very comfortable because the show starts right now.
Hi, and welcome to this week's Author's Corner. As usual, I'm here with Jim and Dan. They are best-selling authors, TV personalities, and radio talk show hosts. Guys, I have a great set of questions for today. And you know what? Today's about half-truths and fake news. And Jim, I'm going to begin with you. And when you hear people say, hey, just ride it out, the stock market losses, not a big deal, it's only a loss on paper, it's going to come back, what do you tell them?
We would never ride out the market, particularly at the age group of people we're working with. If you're 20 years old and have no money, ride out the market, right? But if you're 50, 60, or 70 and riding out the market when you have a lot of money is devastating. It not only will stress the heck out of you trying to recover in time to be prepared for retirement, it could be disastrous. So no, we're not going to tell you ever to ride out the market.
And Dan, let me ask you, historically speaking, a lot of folks say, well, if you stay in the market every year, you're going to get that 10 to 12% market return. Truth?
Not true. In certain years, you'll get 10% rates of return or higher rates of return in certain years. But in certain years, you might lose 10, 20, 30%. It just depends. When you look at what you should focus on, and that would be your average rate of return. Just to give you some basic statistics. If you go back to the year 2000 and go all the way through the end of the year 2022, that's a 23-year time period. The S&P 500, which is considered the largest 500 companies in the United States squished together in one index, it would have averaged about a 4.28% average compounded rate of return, far short of that 12% gain. If you then look at what happened since 1996 and look at every 15-year time period, and there's 13 15-year time periods, the stock market has only averaged, as the S&P, 5%, 5.07% per year compounded for every one of those 13, 15-year time periods on average. So when you say 10 or 12%, yeah, you might get them in some years, but look what happened in 2001 and 2, 2007, 8, 9, when you lost 50%.
And listen, if you're in your 60s, you don't have the time to make that up anymore. Fair statement?
You definitely do not have the time to recover, and that's the biggest enemy you're going to have if you suffer a big loss.
And let me go one step further. I think sometimes when we have a big run in the market, which is going to happen, there's this false sense of exuberance. Oh, that's never going to happen again, a 50% drop. But would you say that it's fair to say that it's not if it's going to happen, it's when it's going to happen, another major loss in the stock market?
Always. And the two things that guide people's investment decisions, Jim, are fear and greed, right? And you look at those two things really guiding everything you do. Well, we like to make sure people aren't going to have something bad happen to them. So maybe discuss what's happened since 1929 as far as those potential losses in the market.
Including what we're going through right now today, we've had 17 major drawdowns in the market where the market lost approximately 39%. And it's huge. And if people don't realize that when they're getting ready to retire, or if they suffer that in retirement and they're taking income off their portfolios at the same time, it can be disastrous.
Well, based on what you just said, that means on average, there's a 39% loss every 5 years in the market historically. So if you're 60 and you're going to live to 90, that means you're going to have 6 more 39% losses that you have to somehow navigate through while you're trying to use your assets for income, hoping you don't run out.
You know, you segue me great into this next question, which is, hey, I've saved up a sizable amount of money. Now I'm going to take 4% or 5% or 6% out of it every year. That's not exactly the best strategy now, is it?
Well, not necessarily. You could do that, but you have to consider different financial instruments, because taking 4 or 5% off a managed portfolio in the stock market, it may not work for you, because if you have years where you lose money and you have to recover and you're taking money out at the same time and you're paying taxes, you're paying fees and transaction costs, that probably won't work.
We'll take an example of 2007, 8, 9. If the market went down 53% over about a 16-month time period, and you're trying to pull 5% out on top of that, plus paying fees, plus paying taxes, what's the chance your money's actually going to last throughout retirement?
Yeah, and getting back to even becomes incredibly difficult.
Difficult, if not impossible, when you factor in income, the loss, fees, and taxation.
And speaking of taxation, when it comes to IRAs, deferring it, good idea. What's the taxation piece on that?
We believe, and my background is an enrolled agent for 30 years with the IRS. I'm an accredited tax advisor, and we believe in most cases, you have to do a plan, so each circumstance is different, but in most cases it's better not to defer. We see so many people at age 60, 62, 65, and they're told by their CPA or they're told by their advisor to wait until 73 because they don't have to take income distributions. Well, they're trying to defer taxes and reduce their tax bite. But if you defer, what's going to happen to the value of your assets? They're going to increase from now, so let's say 60 to 73, you're going to have more assets. Well, at 73, they're going to force you to take money out of your account. And if you have more assets, what are they forcing you to take out? More income at a time you probably don't need as much income at 73 as you did at 60. On top of that now, you'll pay more taxes, but when you pass it on to your beneficiaries, the new law requires your beneficiaries to take that money out over 10 years. So if you defer this huge amount of money, now you're passing on a tax time bomb to your son and your daughter.
Dan, Jim, thanks so much. Hey, if you want more information about anything we spoke about here today, let's start a conversation. Pick up the phone, give us a call right now, 916-452-7325, or go to our website. And don't go anywhere, we'll be right back.
Hi, I'm Jim Files, CEO Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
On this week's segment of We Fix Your Money, you're going to meet Shelley. She has no pension and is trying to take care of more than $3 million all by herself. She's scared of making financial mistakes like taking too much risk or running out of money in retirement. Now over to Dan and Jim to tell you how they helped Shelley.
Thanks, Mark. Yes, Shelley is going to be a great example of someone that we could potentially help put into a significantly higher financial security position. And when you look at someone like Shelley, age 68, let's say she's recently divorced. She gets Social Security, but she doesn't get a pension. She has $3.1 million of assets, but only $20,000 in the bank. That definitely doesn't make her feel comfortable. She's never handled the assets because her ex-husband handled the investments. She did the budget. She has no debts, and she's ultra-conservative. She knows she needs an actual plan, and she wants it in writing so she can finally feel comfortable. And she wants to stop worrying so much about her money. She doesn't want to worry about potential risk and big losses anymore. She hates the thought of the market crashing. Her big fear is that her money will run out before she dies. She wants help taking care of the money because she worries about it. She has a decent-sized monthly budget that she wants to make sure she's always able to pay for, and she'd love to be able to leave money to the kids, and she's worried she might not be able to because she might have to use it all for herself. So when you look at this, this is a typical type of case study that we would do for someone.
That's exactly right, Dan. And what we're going to show you here next is Shelley's current plan and how we modified that plan in blue, which is called the new plan. So in her current plan, Shelley had $20,000 in the bank. She had over $3 million in investable assets, that's stocks and bonds. She had no principal protected or lifetime income, and her total assets added up to $3.1 million. Based on Shelley's objectives, we divided that money up differently. We actually increased the bank money to $200,000. We reduced the amount of money in the market because of the risk component. We increased the principal protection and lifetime income to $1.8 million. Same $3.1 million, we just rebalanced it. And then we did a risk assessment. We used outside third-party companies to figure out how much risk a client has in a portfolio. She had a minus 43.3% risk factor, which means that the market dropped by 50%, she proposed to lose 43% of her money. That would mean she would be down $1.342 million. And that would mean, more importantly, that she needs a 76.4% gain to make up that 43% loss, which is tremendously difficult. When we modified her plan under the blue there, we reduced her risk to minus 4.2%. Again, if the market goes down by 50%, she has proposed only to lose approximately 4.2%. It's still not risk-free. She would lose $130,000, but not $1.342 million under her old plan. And to recover that loss, we only need a 4.4% rate of return to make up a 4.2% loss. So that was a significant change in the plan details, Dan.
And this is kind of typical when you have a current scenario. Someone comes in, they have their assets allocated, a little bit in the bank and almost all the rest of it in growth. And they're trying to get income and they're trying to protect it from losses, so their assets are allocated completely the opposite of being able to attain their goals. That's why we modified their plan, because it's their goals, and this allowed us to first get her risk below 5%, which is what she wanted to do. She's okay with up to a 5%, so she has a 4.2. It's a great start of a plan. Then we do this so we then can start doing her income plan. And if you look at her current scenario, she was taking out about $50,000 a year from her current assets, and that's what her broker told her she could take. Well, she needs more than that. She wasn't getting any of the income on a guaranteed basis, and we didn't have any of her assets originally positioned for guaranteed lifetime income. With her new plan, she's going to be generating $125,000 of income from her assets, with $95,000 being guaranteed contractually for as long as she lives. We used about $1.8 million of the assets to create that $95,000 of pension-like income. So it really helped to solidify where income was going to come from. And then we did a fee analysis and assessment. And currently, with all the fees she was paying, the advisor fees, the management fees, the fees she couldn't see, like mutual fund fees and trading costs, she had a pretty decent fee structure of about 1.92%, which wasn't bad at all. And we structured her new plan where her new total fees in writing were 1.37%. And if you look at that savings of fees over the next potential 20 years, it's over $340,000 of potential fee savings that stays in her pocket versus over into the financial industry's pocket and her advisor's pocket. So it was a really great way then to enable her to increase her income by first getting guaranteed income, but also reducing her fees.
Exactly right, Dan. So then what we wanted to do is we wanted to figure out, okay, how are we going to flow income to Shelley? So she had gross monthly income in the new plan of $12,577. State and federal tax was going to be about $3,000. Net after-tax monthly income, $9,493. We added her budget, which is $7,000 a month. That included all of her spending. That was her mortgage payment. That was including entertainment, travel. We got her excess cash flow of $2,493 above her budget of $7,000. And that's significant because that adds up to $29,916 every year in what we call excess cash flow. That can be used for lots of things that come up in life.
When you look at what this chart's showing, this is the same chart we can produce for you individually. It's going to show what your gross income is, what your taxes are going to be, what your net income after taxes are, subtract your budget, and it gives you your net excess monthly income, which is what you want to know, because that's financial freedom. Financial freedom is having more money to spend than you need each month. Well, when you look at then long-term what happened with this particular plan, Shelley was worried about herself, which we were able to show her. We can put a plan together that'll give her more income than she needs to pay for everything and have excess monthly cash flow. So then she immediately went into, well, what is my beneficiary? What's going to be my legacy? What am I going to leave when I'm gone? So let's assume some very conservative numbers. Let's assume her portfolio assets earn 4%, her bank earns 1.0%, her real estate appreciates at 1.5%, and she spends all of her income. And at this point, we look down the road, and at age 90, she would then have taken out income of $3.1 million from her assets by that point, which is just awesome. She's used her assets and spent it on the things she wanted to do. And if she just earns those conservative rates of return, net of taking out $3.1 million of assets, she's still able to leave $3.7 million to her beneficiaries, which is great. By accident, she gets to leave $3.7 million to her kids and grandkids, which is what she wanted. So when you think about everything that was achieved for Shelley, it was awesome.
Yeah, we did exactly what Shelley wanted. We gave her a full written plan before she invested the money. We reduced her risk. We reduced her fees. We gave her $30,000 of extra cash flow beyond her budget requirements, enough income for her entire life. She can now understand and handle her money. She can leave money to her children, which was one of her objectives. And guess what? She has a lot less worrying, Dan.
Well, in Shelley's case, might not be exactly like yours, but it still can fit. It just shows you how you can handle some of your biggest worries by actually creating a true plan. Mark, back to you.
Wow, what great results from a great plan. Your situation might be exactly like Shelley's. You may still be working or you may be married, but you can see how planning can help you attain your goals and alleviate some of the worries about money. If this is something you would like help with, give us a call in the office right now at 916-452-7325 or visit our website. Now stay tuned for a great complimentary offer.
Hi, I'm Dan Ahmed, president of Peak Financial. We have a great free offer for you. We're offering you a free, worry-free retirement roadmap that includes a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all for free. No pressure, no obligation, guaranteed. Call the phone number on the screen or go to our website to claim your free offer. You have nothing to lose, there's no risk, and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome back to the program. Now let's listen in on the Peak Financial Freedom Hour with Jim and Dan.
Jim, it's great to be back this week for our radio show, and we're going to take some really good questions that we've dealt with in the past as far as people wondering about their money, because everyone's so worried and they really want answers on what they need to do for that next step to become more financially secure. So let's look at Daryl and Karen. How about? They're both 63. They want to retire as soon as possible, but all the stock market volatility is scaring them. So 63 and they want to retire. They've saved about $3 million. They've done really, really good, but they don't have pensions. House is paid off, and we can start $50,000 of Social Security now. Do you think we can retire? So $3 million of assets, $50,000 of Social Security, no house payment.
Well, I don't know a lot about them, but I can kind of respond to the thought process. They've done a great job saving $3 million, number one. Number two, because they did a great job saving $3 million, they probably were frugal with their expenses. So I have to assume they have a budget that they can manage through. And with that being said, probably a great chance they can retire successfully. But again, until we have more data, we probably can't determine exactly how to do a plan, but they've done a really good job.
Sure, but if you look at this scenario, so they have $3 million of assets, we probably can generate at least $150,000 a year of income from the assets, plus the $50,000 of Social Security brings them right in at about $200,000 of gross income. That means they're probably going to be somewhere around $14,000 of net income after taxes, just as a rough guesstimate, but they could probably be there with no house payment. They can probably live an awesome, awesome retirement just with that type of data, and they can retire now at 63, not have to worry about working until 67 or 70, most likely.
And the neat thing about it, Dan, too, is we can put them into financial instruments whereby if they are afraid of the market, we can reduce that risk quite significantly.
They said they are. They said the stock market volatility scares us, which probably means, without them knowing it, that they have a lot of volatility and a lot of chance for loss. They could be losing 40 or 50% in the next stock market crash, and they can't be at that position if they're 63 and want to retire. They have to be in a lot less volatile portfolio, maybe somewhere like our 5 to 10% rule, not having more than a 5 to 10% loss projected if the market crashes 50%.
Yeah, I mean, based on what you've said so far, I think that would fit really well with these clients.
Definitely. So I think that'd be great. How about let's look at Marjorie, 65, retired. She says she doesn't understand her money or her statements other than it goes up and down. And it seems, especially recently, to go more down than up. She's worried that a stock market crash would kill her $1.5 million portfolio, but her broker always says, not to worry, hang in there, ride it out, everything will be fine. She says, but I can't help it, I worry anyway, and she's really deathly afraid she'll run out of money. She says, what can I do? Well, it's kind of almost like the same scenario Daryl and Karen are in, because right now Marjorie, she's worrying about retirement, she's worrying about big losses, she's worrying about her money running out, she's worrying about how to create income that will be dependable for her, and she doesn't have to worry about it ever running out. And we can do those types of plans because most of the people that come to us, they're frugal, they've saved money, and you can only save money if you don't overspend. They're conservative, they don't want to lose a lot of money, and they want to create a plan, and they want everything in writing that will show exactly what's going to happen over the next 20 or 30 years. So maybe for Margie, if she came in, what kind of plan would we develop? What would be in writing for her?
Well, first of all, Margie, she's single, obviously. I don't know if she's divorced or her husband's deceased, but nevertheless, we deal with a lot of people that are in that situation. So she's frightened, right? She's by herself. She has to fend for herself and make sure she makes the right decision.
Definitely.
So she does need a full plan. She does need a retirement plan. She needs an income plan. She needs a risk plan. She needs a fee plan. She needs a legacy plan. If we can do all these things for her, which we do for every client, I think it would allay a lot of the fear she probably probably has deep down.
Definitely, yeah, because if we could show her that we could reduce her risk to somewhere in the 5% range, she might worry, but not as much. If we can show her on one page where all her income is going to come from every year from each source for the rest of her life, we can show her how much tax she's going to pay, and we can show her each month how much net after-tax income she's going to have in her hand to spend, she will worry a lot less about her money. So 2 great clients, 2 great situations, case studies. I think it's just wonderful to be able to help people like this.
Yeah, exactly.
It's a really good show, and if you have these types of questions, just feel free. Call us. We'll be glad to answer some questions, glad to meet with you, or just go to our website, and hopefully we can do the same thing for you.
Thanks, guys. That was some great information. Don't go anywhere. We'll be right back.
Hi, I'm Jim Files, CEO of Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Retirees have so much to worry about right now, from the risk of big losses in the market to their income running out. Today on Peak University, Dan and Jim are going to tackle the scary subject of long-term care.
Thanks, Mark. You know, long-term care can be very scary to retirees and people planning for retirement, Jim. No one knows if it's going to affect them. Will they need long-term care? And even worse, how much it's going to cost. Those 2 things can be very uncertain and cause a lot of anxiety. So because of that, you and I have talked about creating rules for long-term care and how you can hopefully prepare and be in better shape financially if you do need long-term care. 3 simple rules. First rule is going to be create dependable, guaranteed lifetime income. And that's important because if you have income coming in for as long as you live, you then have an opportunity to use some of that income to pay for that long-term care. The second is to have the opportunity for your income to increase because long-term care costs are going to increase, so your income better have the opportunity to increase. And the third rule is have the opportunity for your income to potentially double if you need long-term care. Now, if you use those 3 rules, what's going to happen to people as far as the potential for succeeding to pay for those long-term care costs?
Well, they have a much greater chance of making sure those long-term care costs are taken care of if you plan in advance. And if you don't plan in advance, things can happen in your life when you enter retirement. And it's really important when you enter retirement to make sure you don't lose a lot of money. That's the key to success in retirement.
Well, and that's really our next slide to cover because you have to create income that won't run out. But the number 1 way to do that is to make sure you avoid suffering large losses. So when you look at all the big losses in the stock market since 1929, and you go back, there's been 16 of these, and a bear market is when the stock market goes down 20% or more. So maybe cover how that works, Jim, just to make sure that people understand you cannot have a large loss when we're starting to go into retirement, especially if we're worrying about paying for long-term care costs.
Yeah, Dan, you know, we study bear markets for this very specific reason. Number 1, if you lose a lot of money when the market goes down, it's very difficult to recover from. There's been 16 bear markets, not including the one we're in right now over the last many years. So we go back to 1929, each one of these red bars represents how much the market went down during that period. So every 5 years, on average, we have a bear market, and the average bear market lasts approximately 1.5 years, and the average person loses, if you're in the stock market, about 39% of your asset value, which is really, really significant, Dan.
When you think about that, let's say someone's retired and they're 65 and they're married, and there's a high probability one of them is going to live into the 90s. That means if you can imagine having to go through 5 more, trying to traverse 5 more 39% losses while you're taking income out of your account and then trying to potentially help pay for long-term care. How can you actually do that?
It's very, very difficult. And most consumers don't understand this data, and it's not explained to them by the industry, right? Wall Street doesn't want you to understand this because if you really understood this clearly, you may not be invested the way you are. You may not be invested at all when you get close to retirement. So you have to consider these facts to make sure you design a proper plan to navigate through this. You're not going to get around this bear market, but you can construct your portfolio so that you can navigate through this type of stuff.
Well, I think that's important because if the assets behave like this, can you really use them for long-term care expenses? And the answer is probably not. Well, let's look at what happens if you have assets in a stock market type investment and you lose 53% like what happened in 2007, 8, 9, and then you actually need 112% gain just to recover. And the question is, if your assets are positioned like this, can you really use these for income that will pay for long-term care, and will it last? And the answer is probably not. If you look at mathematics, the probability is going to be very low. So what if instead we now use an asset that will give us, number one, dependable income, and it gives us a chance for growth? Well, what if now we use a fixed indexed annuity with an income rider with potential income increases? So let's say now the stock market crashes and your $1 million invested goes down to $777,000. How would you like to still get $50,000 of income that flows to you on an annual basis, even though the stock market crashed? Stock market crashes next year, you still get your same $50,000. Stock market crashes the next year, you still get your same $50,000. So the stock market crashing has not affected your income in any way, shape, or form, which is what we want for retirement, especially if you're looking for long-term care. Now, what if the index or the market starts to recover and it makes an 11.4% gain? What if you don't get it all, but what if you get half? Half of that gain, but the gain is credited to your income, and now your income goes from $50,000 to $52,850, and now that income is locked in for the rest of your life. And every time you get an index gain, you get a portion, not all of the gain, credited to your income, so your income continues to grow. How about after 3 years of growth, you're up to $59,000? How about we get 7 years of growth, which is just recovering, and your income now has increased from $50,000 all the way up to $73,705. That's an awesome income increase. But what if then you're using that for your normal living expenses and then long-term care hits? And let's say long-term care hits, and at this point, instead of the market crashing, how would you like your income to stay at the highest level? Isn't that what we all want? To be able to have increased income, and when we gain that income, never to reduce. But what if now we have a long-term care event that happens after 5 years? And we're not able to perform 2 out of 6 activities of daily living, meaning you need long-term care. And we have a positive account balance inside of your annuity. Well, how would you like then after 5 years your income to double from $59,000 to $118,000, and you get to use that to pay for long-term care? If it happens in the 6th year, your $62,000 goes to $124,000. If it happens in the 6th, 7th, and 8th and 9th year, we're up to $147,410 of income that you can use to pay for long-term care, Jim.
You know, Dan, that's awesome. And the consumers don't understand there's these type of financial instruments out there that will help them alleviate those stressful thoughts of, what if I do need long-term care? What if my spouse needs a long-term care? Because when you look at this data, and if you were in the market and you were going down like you would have gone down in 2008 and 9 or during the technology bust, you would have not only gone down in the market, but you would have reduced your balance by another $150,000 with income. So this is an awesome product to achieve those goals, Dan.
Thanks, guys. That seems like a fantastic way to create income that won't run out. And if you want more information about anything Jim and Dan spoke about today, give us a call in the office, 916-452-7325, or go to our website. And don't go anywhere. We'll be right back.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Thank you for watching this week's show.
And if you want more information about anything we talked about here today, give us a call in the office or go to our website.
And remember, at Peak Financial Freedom Group, we fix your money.
The preceding program is sponsored by Peak Financial Freedom Group.